Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening. No matter where you are joining us anywhere in the world today, welcome to the Debt Doctor podcast. I'm your host, America's most qualified debt doctor, Bill Bymel. So who is this podcast for? If you are a default professional, real estate broker, lawyer, vendor, title company, contractor, mortgage loan officer, this is definitely the podcast for you. If you're an investor looking to diversify out of equities, out of more traditional investments, and hey, you want to take a little bit of risk, but you like the security of having an asset-backed investment, then this podcast is for you. If you are a banker or a loan officer or a private equity fund manager, maybe in your 20s or 30s, and you haven't ever experienced a portfolio going upside down, or you have, but you just don't have the manpower to deal with it, maybe a DSCR portfolio that for some reason all of a sudden these loans have stopped performing, this podcast is for you. And maybe you're just an investor, institutional investor. Maybe you work for a private equity fund. You're out on your own. You're looking for ideas. You're looking for deals. You're looking for perspective on the market. You want to stay ahead of where the public is. And all you got to do is follow the news and listen to the Debt Doctor podcast. This podcast is for you. I've been in the real estate business for over 20 years. And really, you could say I grew up in the real estate business. My father was a real estate broker, so I used to listen to him talk about deals and how much real estate had made the most self-made millionaires and created the most wealth of any asset, any investment class in history. And so I got into real estate in 2002 when I was passing through Florida on what I thought was going to be just a road trip to see my parents. What ended up happening as I got into real estate, but my father, who was a broker, convincing me to get my real estate agent's license, I said to him, Dad, I want to do things differently. If we're gonna get into this business together, then I want to practice what you've preached all along. We need to invest. And so for over 20 years now, I have invested in residential, commercial real estate. I've been an advisor to other clients, to major corporations, especially on the commercial side of the business, working with multinational corporations like McDonald's and Family Dollar, major banks, to help them with their expansions on a national scale or locally in the state of Florida, where much of my practice went. So how does that relate to the Debt Doctor? Well, I've always grown up with debt being a fear, something that hangs over me. My parents always used to talk about their credit card bills and how always having to be frugal. Our family often spent our dinners going to early birds and 2-for-1s, and my dad was always looking for free buffets, broker open houses where we could steal a meal. And so when I got to college, I was fortunate enough to attend New York University. And at the age of 18, American Express handed me a $20,000 credit card. Now, I handled that well for a brief period of time. But by the time I was 19, 20 years old, I decided to make my first movie on that credit card. And ever since then, I have spent my life dealing with having to pay back debts and how does one manage that. Thank gosh, through the trials and tribulations of my life, I've always been able to make money. I've never had to seek debt consolidation, debt advice, never even considered the possibility of bankruptcy. So, for most of my life, I have had the experience of dealing with borrowing money and having to pay it back. That is the American way. And so it was very interesting in 2008, that's 17 years ago. I was working in real estate at the time. I owned a couple commercial pieces of property, a couple residential investments. I was building my business in South Florida, raising kids, newly married a few years. And it was the summer of 2008. And for those of you who were around back then, you'll know that the market was in a, I wouldn't say in a downward spiral, but it was in an area of uncertainty. The downward spiral really happened in the end of 2008 and kind of continued for a few years, in real estate at least, nationwide. So it was 3 months before the fall of Lehman Brothers. I get a random phone call from someone who was buying mortgage debt on the secondary mortgage market. Now, at that time, I had no idea that existed, that there was a market which we call the secondary mortgage market. You'll hear a lot about that on future podcast episodes, and you'll hear me talking about secondary. I wrote a book called Win-Win Revolution: How to Profit from in my years in the secondary mortgage market. But that call with a fund manager in the summer of 2008, 3 months before the fall of Lehman Brothers and the subsequent market crash that caused the implosion of multiple mortgage securitization entities, mortgage lenders, many banks failed. Well, all of that started in with a slowdown that was happening in real estate in 2007, where all of a sudden folks couldn't afford the inflated values that real estate had. And at the time, interest rates were kind of where they are right now, maybe a little bit higher, 8% average. And we saw markets go from hot, undersupplied, everyone speculating, buying, which was categorically the story of the early 2000s, to 40% of mortgages being underwater a year later. And for me, when I got a phone call from a fund manager about the secondary mortgage market, what he told me was so interesting. See, loans, whether they're real estate asset backed loans or auto loans or credit card debt, all of this huge amount of debt that we as Americans consume and use on a daily basis, the billions, if not trillions of dollars of debt that we as Americans live off of, that this economy, that this society really lives off of, it doesn't just stay with the person that lent you the money. That these loans get transferred from one lender to another investor to a pension fund. Sometimes they get thrown into bonds. Sometimes they get thrown into securitizations or even more complicated financial products, things we call derivatives. But that movement of loans, whether they're performing loans, subperforming loans, non-performing loans, the sale of those loans in bulk is done through this secondary mortgage market. It's a for pre 2008, it was pretty much a good old boys network, who you know, and it was kind of like a stock. It was a stock trading platform, but it was done over the phone between loan traders, and that still exists today. There are still folks in New York that trade millions or even billions of dollars of loan portfolios just on a phone call. Wow, this was so unique to me. Why was it so unique? Not just because the market existed, but the guy on the other end of that phone call in 2008 said to me, I'm looking at a pool of 2,000 construction to perm loans in Port St. Lucie, Florida. These were all brand new homes, 2,000 square foot ranch style on quarter acre lots in Port St. Lucie, which, if you know Florida, that's about 30 to 45 minutes north of Palm Beach and about an hour and a half north of Miami, hour and a half south or 2 hours south of Orlando. And what this guy said to me, this fund manager, was, hey, the market's imploding right now. This pool of 2,000 loans I'm looking at is from a bank that's out of business. I'm talking to the FDIC, and I can basically name my price for these loans because they got to liquidate this pool. The government's not going to hold on to it. And no one knows where the market was going at that point. It was a falling knife. I've now spent the last 20 years working in and out of the secondary mortgage market, buying loans from banks, private equity firms, pension funds, other sponsors and lenders, new origination groups, servicers, individuals, through the court from trustees and bankruptcies. I buy anything that's distressed that I can buy at the right price. See, my mentor in this business told me there is no such thing as a bad loan. It's all just a matter of how you price it. And when you price a loan that is non-performing, but it's backed by real estate or some other hard asset, but when it's backed by a hard asset and you have a first lien priority position on it, well, the lender in that position is pretty secure. Now, if you're a second mortgage lender or you're a third mortgage HELOC, or if you're buying debt that's unsecured, the kind of stuff that we would consider unsecured is credit card debt, student loan debt, things that aren't tied to anything of intrinsic value long term. Well, you expect when you're buying that in distress, you're really getting discounts. So I've spent the last 18 years buying distressed situations. We try to take the savings we get from the purchase the day that we buy them from a bank or a failing institution. We usually buy these loans at a discount to the face value of the debt and at a safe underlying LTV, loan to value, of the asset value that it encumbers. That's why it's so secure. That's why I love this business. And that's why I've spent the last 18 years in it. Because, listen, in essence, when we went out there and bought those 2,000 construction to perm loans in 2008, everyone whose loan we were buying was underwater. Every single one of them. Because what had happened back then was people had gone out, speculated up the price of these quarter acre lots 90 minutes north of Miami. They were $10,000 lots in the early 2000s were going for 100,000 or more in by 2006, 2007. You plop a $200,000 construction of a house on top of that, people are sitting in $300,000 worth of debt. And by the end of 2008, those houses were worth 120, 150. Brand new, never lived in, and you couldn't sell them for what it would cost you to build them. That's a warning, folks. If you're young and you haven't been through market cycles, well, get your popcorn ready. This is why we've developed the Debt Doctor podcast. The mission of this podcast is to deliver definitive prescriptions for navigating distressed real estate debt and have conversations about all the specialty finance options that exist. Now, while the focus is real estate debt, because I'm a student of real estate, I've lived in it, I know it. I feel like real estate debt, especially first lien debt, my company is called First Lien Capital. You see where my focus is. First lien debt, I consider it to be the best, when purchased at a discount, to be the best risk adjusted return for an investment in anything. Because in essence, you control the asset. You know, in the case of 2008, when we were buying those loans that were underwater, we controlled everything. We owned debt that was greater than the value of the real estate. So when we talked to borrowers, we held the cards. And inside of the mission of definitive prescriptions, we did the right thing, and we do the right thing. And that's the other reason this podcast is called The Debt Doctor. Because doctors have a fiduciary responsibility. There's a fiduciary responsibility to your patients as a doctor. Just like there's a fiduciary responsibility to your clients when you're a real estate broker or a financial advisor. And so when we buy stuff at a discount, we don't go to squeeze every last dollar. Most of the borrowers who are dealing with distressed debt situations, they're already in a tough spot. We're not there to dump salt in their wounds. And so that is what this podcast is about. How can you go out and make huge returns for your investors very safely by buying debt that is asset backed? And it only works though if you know how to deal with it after you buy it. If it was so easy, everyone in the world would be doing it, and I wouldn't have as much competition. I would have a lot more competition, sorry. I wouldn't have as much ease at saying, hey, we're the definitive group. As we launch this podcast and embark on this exciting journey together, here's what you can expect. What you can expect from me is honesty. You can expect from me transparency. You can expect from me the real story. You're not going to get politics. Well, you might get it from some of my guests, but I'll try to stay out of the fray. And we're going to do a deep dive into what makes distressed real estate investing different. Things like what I pointed out, the fact that you can be a lender in possession of a loan that is greater than the value of the collateral you encumber, meaning greater than the value of the real estate, greater than the value, and you can buy that stuff at a discount, and how do you work it out? And it's a secure investment, still secured by a hard asset, and it gives you all the cards. And we're going to talk about how to do all this while treating people with dignity, while treating borrowers with respect. Why? Because as I mentioned, my 19-year-old experience of having no job, making my first movie on an Amex card, and having to deal with the servicing of that debt, having to deal with what we all deal with. Because you, my friends, my listeners, whether it's real estate backed debt or just unsecured debt, we've all dealt with it. And so we're going to talk about on the Debt Doctor, we're going to focus mostly on what we do, which is buying, performing, non-performing real estate debt at a good LTV, safe underlying loan to value to the real estate so that we know we have a secure investment. And then talk about all the tricks and the trades and where the industry is going and where the opportunities lie. You'll hear from industry cohorts, you'll hear from competitors of mine in the business, you'll hear from vendors, lawyers, doctors, investors, loan officers, the whole gamut. Malcolm Gladwell wrote a book a few years ago that won the Pulitzer Prize. It's called The Outliers, and one of my favorite chapters is something called 10,000 Hours. And the idea, the theory in this chapter is that all of the great professionals in life, whether you're talking about Bill Gates or famous hockey players or whoever it might be, all had a number of things in common, but one of the key attributes was they all had an opportunity to spend thousands of hours inside their craft. And Malcolm Gladwell's theory is that you're really never not an expert on anything until you spent 10,000 hours. Well, I will tell you, not only have I spent over 10,000 hours managing real estate, managing distressed debt, working with borrowers, working with lenders, working with investors on the resolution of non-performing, subperforming debt. But I've done this on thousands of loans nationwide. My partners, the people you'll hear from in these episodes, have done the same. I've been in residential real estate. I started as a fix and flip investor when I got my broker's license. I moved into commercial, so you'll hear perspectives. I was a tenant rep broker for major restaurants and retailers that were doing expansions in South Florida for almost a decade. So I was involved as a broker advisor both to developers and to tenants and retail tenants, going to the ICSCs, being involved in ground up developments of CVS's on corners and banks on parcels and Starbucks, McDonald's were clients, etc. And then 2008, while I was happily pursuing that career, I got that phone call that I mentioned earlier. That was the light bulb moment. Then I spent 10 years working for a New York fund, and we bought over $1 billion of cash invested in mortgage loans we bought at discounts. And through those thousands of loans, one of the things I'm most proud of is how we've done things differently. I mentioned treating borrowers with dignity. Well, when we buy a pool of non-performing loans, the first priority, the first thing we always try to do is help the borrower retain the asset and recover. So the first objective, the first priority of any non-performing situation we come across, we invest in or manage, is we call those borrowers and say, how can we help? How can we help you get out of it? If it means a 6-month trial to mod, if it means a 90-day forbearance, if it means a lump sum payment for a portion of the past due and rolling the rest back, we will work with you. And that's what we can do as private equity. And then for that middle 50% where that's just not an option, maybe they're downsizing, maybe they never should have bought this property to begin with, or the market has changed and they'll never recover, they don't want it, we allow those folks to exit with dignity. And then there's always folks that think that they don't need to pay their debts back, of course, or that somehow their word doesn't matter, or somehow they can get one over on us or on the lender. And so, unfortunately, we do have to foreclose or take to court. So we've now encountered thousands, if not tens of thousands of distressed debt situations. We've invested, like I said, over $1 billion. I've been personally involved in the management of hundreds of millions of dollars of acquisitions and resolutions. And this approach, by the way, when I got into this business, I didn't want to be a debt collector. Who wants that? Especially when your first experience out of college was maxing out an Amex card and having to deal with collection calls. In 2008, I got stuck with one of those properties upside down. I spent, as a guy who was a real estate investor, in 2007, I guess I can call myself lucky because I have friends with dozens of properties that were over leveraged prior to the GFC, the great financial crisis of 2008. Those folks ended up with much worse situations, but I had one property that was upside down. And I know what it was like to try to call a servicer and work something out with them and have them not pick up the phone. Or worse, most of the collection companies and the servicers, whether it's real estate loans, credit card loans, student loans, auto loans, whatever it might be, The person you're talking to has no control. The system is so disjointed and so bureaucratic that if you have a situation, then unless you're dealing with someone like us, a private investor with the knowledge, the experience, the flexibility, it's a really frustrating process to deal with that when you can't afford to pay it. And you know what I'm talking about. You all probably have been there. And if you are one of those fortunate people who spent your life out of debt or debt free or just didn't believe in it and you've always managed to pay in cash, good for you. That's wonderful. But our approach to dealing with distressed debt situations revolutionized the industry. So much so that I wrote a book about it in 2017 called Win Win Revolution. Win Win Revolution is a book I wrote about those days from 2008. It's really a how to. It's meant to do two things. It's meant to teach people kind of the basics of loss mitigation, what to do if you buy an asset backed loan like a first lien mortgage that's in default, and how to deal with it. What are the options you can present the borrower or deal with on yourself? But it also talks about the approach. And going back to the fact that I never wanted to be a debt collector, that was not what I was interested in. What I was interested in was the ability to have a positive impact on people's lives, especially people like borrowers who are in distress, and to do so and to make money and to have those cards and to have the power as the lender to make an impact on people's lives and to do the right thing. And to do the right thing knowing that I've already made my money. We bought those loans at a discount. We can do the right thing and still do well. So that'll be another topic of conversation. Where do you draw the line? When does enforcement become the most important or the most ideal situation? Or when do you give up a few dollars and let someone have a second or third chance? So, what's the distress landscape like? Well, let's just talk a little bit about what we will talk about. We're going to talk about performing loans. We're going to talk about sub-performing loans, and we're going to talk about non-performing loans. There's three categories of debt. Now, performing loans are a no-brainer, right? They earn an interest rate. The investors in that are looking just for the cash flow off of it. The borrowers in those situations usually have good credit. They want to keep the real estate. They want to keep whatever asset it is that's backed. Subperforming loans are loans that, well, it's pretty self-explanatory, right? A subperforming loan is a loan where maybe the borrower's constantly 35 days late, or maybe they're a payment or two behind. Maybe they are current now, but 3 months ago they fell back for 2 months and then got caught up. Subperforming loans, also we put in this what we call scratch and dent loans. So scratch and dent loans probably fall into that subperforming area, even if they are fully performing and aren't in default or never late. There's other aspects to it, because in order for the loan to have value on the secondary mortgage market, in order to be resellable, it has to meet certain characteristics. All the loan files have to be correct. There needs to be, especially when it comes to government backed and government insured loans, there's a whole set of criteria. So you're going to hear stories about that. You're going to hear stories about individual cases. There have been story after story I can tell you about loans that we bought, where the previous lender was a big bank or an institution. And because they're dealing with thousands of loans and they don't have the capacity to talk to borrowers and really deal with managing the trees as opposed to the forest that they manage, well, we end up being the fortunate benefactors of that. You know how many times I've knocked on doors over the years, and I say that in the old days, I mean that literally. I would knock on doors in 2009, 2010, 2000, all the way up to the 15s. And I'll still do it once in a while now. But I literally would go into neighborhoods, people that hadn't paid their mortgage, knock on their door and say, hello, my name is Bill Bymel. I'm not your lender, but I'm associated with them. I'm associated with the servicer. Here's proof of it. I know these people are good. Let's talk. I'm not here to collect the debt. I'm not here to tell you get out of the house, but I am here to discuss your options and talk about your intentions. And inside of that approach, wow, you can imagine how many borrowers were so happy to see us. You don't know how many folks, when we opened those doors, especially in the early days when they were underwater and had no idea what to do, said, oh my gosh, I've been trying to call the servicer been trying to call the bank for months. I'm ready to hand over the keys. I've got a new place down the road. Where have you been? I've got a buyer willing to buy the house at 150, even though it's only probably worth 140. It's a short sale though because I owe 200. How do I get this worked out? We've done that with thousands of cases, thousands of people whose distressed situations we've turned into not only profitable for us, but win-wins. That's the point. One of the things I used to tell borrowers who were in this situation is you cannot understate the amount of freedom that you will feel when you get this behind you. When a distress situation hits us as humans, it can color everything in our life. And I've seen it, I've experienced it, and I've seen it over and over again. When someone is in a funk, and when you owe a loan that you can't pay, that's a stressful situation. And to be able to give borrowers that freedom to move on with their lives, to open up something new. I've seen it when in my own situations when I've gotten beyond distressed situations, a whole new world of possibility opens up, and I still get Christmas cards today from folks I helped 10, 15 years ago. That's the kind of impact we can have. That's the kind of impact we're going to teach you about. And the other important thing to be aware of is the fact that the NPL business, the distressed debt business, is very undercapitalized, and there's not a lot of competition right now. You got a lot of big money in Wall Street, pension, private equity, Blackstones of the world. They're all lining up to buy the Empire State Building for 10 cents on the dollar. And yet, folks, in commercial, small balance commercial real estate, and in residential investment real estate, especially multifamily, we are seeing a tsunami of distress building up. And this is the same cohorts, the same members of society, my friends, my family, my doctor, my lawyer, my fireman, the average everyday folks. Some of you know who you are because you graduated from a single family rental to a 12 unit apartment complex, and that loan you got 5 years ago at 5%, you can't get anymore. And in commercial real estate, small balance commercial, or in bridge loan, or in resi transitional loans, these are short-term loans that need to be refinanced at the best case scenario, 5 to 7 years out. So all those friends of ours that are sitting around with office buildings they occupy and maybe rent to others, or you've got a strip center that you bought 7 years ago with a low interest mortgage, well, that's coming up for refinance now. You're going to hear things about maturity walls. Maturity being that period of time when the loan is required to be refinanced because it's matured either through a balloon requirement, and that's very common in commercial real estate. So we're going to jump into all of that. There is a tsunami of opportunity heading the increase in interest rates a few years ago, combined with a obvious slowdown in the market, and it's brought on by one thing, folks: market cycles. Markets are cyclical. And we've done what we can as the governments and leaders have done what they can to prevent the next crash, but the reality is what goes up must come down. So with all of that being said, we are going to provide proprietary approaches to diagnosing distressed debt situations, while we will focus on first lien debt and we will focus on real estate debt. We will go into other areas as well. And then, we'll provide you with frameworks to evaluate potential investments, how to look at the industry, how to look at opportunities. We'll talk about risk mitigation, what separates the amateurs from the pros. My father used to say anyone can make money in an up market. What separates the men from the boys, or the women from the girls, is when the stress hits, who's going to have the resilience and the professionalism to go on. And ironically, it's interesting, we've been able to return double-digit returns regardless of market cycles. Now, when you're a distressed debt investor and distressed debt doctor, the more volatility, the more things are questionable, the more markets are going in maybe the opposite direction, the more opportunity there is. Well, we've been in one upward direction for about 10 years now. Whether it's low interest rates, the creation of new money through post-COVID, whatever it might be, we've been on one direction for a very long time. And it's been a tough market to buy distressed debt in. It's not going to be that way anymore. Double-digit returns will become more common. A return to normality on normalized retail investments will become more common. And that's all just on the horizon. I'm writing my second book right now. It's called The Storm. It's about how financial markets are going to meet Mother Nature. I'm not just talking about Mother Nature from a climate impact, although that's what a lot of the book is about the fact, not how climate change occurred, not what we need to do about it, but the fact that we are having major weather events quite often, to the point where you all are seeing it in your insurance bills. We are now on to a new era. And I don't think anyone's talking about real estate debt or any debt as much as it should be talked about. So thank you for listening. Thank you for joining this podcast. If you like it, subscribe, share it with your friends, leave a quick review wherever you're listening to your podcast. And until next time, remember, every distressed situation has a prescription for success. Be healthy, stay well, and we'll see you on future episodes of The Debt Doctor. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.